Investing in bonds is one of the safest ways to grow your wealth and secure your financial future. But for beginners, the world of bonds can seem a bit intimidating. What are bonds? How do they work? And most importantly, how can they fit into your investment portfolio? Don't worry, we've got you covered. In this video, we'll break down the basics of bond investing in simple terms, helping you understand the different types of bonds, their benefits, and how to get started. Whether you're looking for stability or steady returns, this guide to how to invest in bonds for beginners is the perfect starting point. Today, we will talk about how to invest in bonds for beginners. So before we get started, make sure to hit that like button, also subscribe to my channel. Are you looking for a safer way to grow your money and secure your financial future? Bonds might just be the perfect investment for you. Whether you're a total beginner or just exploring your options, this video will walk you through everything you need to know about bonds, how they work, and how to get started with confidence. Stay tuned until the end because we'll share some insider tips to help you maximize your bond investments. Let's dive into the world of bonds. What are bonds? Let's start with the basics. What exactly are bonds? A bond is essentially a loan you give to a government, corporation, or other entity in exchange for regular interest payments and the return of your principal when the bond matures. Bonds are often considered a safer investment compared to stocks, making them a popular choice for beginners. Think of it this way: when you buy a bond, you're lending money to an organization, and in return, they promise to pay you interest periodically. At the end of the bond's term, they return your initial investment. Bonds can help you earn steady income and preserve your capital, making them ideal for people who want stability in their portfolios. How do bonds work? Now that you understand what bonds are, let's talk about how they work. When you invest in a bond, you're agreeing to the terms set by the issuer. These terms include the bond's face value, interest rate, and maturity date. Face value. This is the amount you lend to the issuer, usually $1,000 per bond. Interest rate, coupon rate. This is the annual interest the issuer pays you, typically expressed as a percentage of the bond's face value. Maturity date. This is the date when the issuer returns your principal investment. For example, if you buy a bond with a face value of $1,000 and a 5% annual interest rate, you'll earn $50 in interest every year until the bond matures. Once it matures, you'll get your $1,000 back. Types of bonds. Bonds come in various types, each with unique features and benefits. Understanding the different types can help you choose the right bonds for your investment goals. Government bonds. These are issued by national governments and are often considered the safest type of bond. In the U.S., Treasury bonds, notes, and bills fall into this category. They're backed by the government, so the risk of default is very low. Municipal bonds. Issued by local governments or municipalities, these bonds fund public projects like schools, roads, and hospitals. The interest earned is often tax-free, making them attractive for investors in higher tax brackets. Corporate bonds. These are issued by companies to raise capital for expansion, research, or other business needs. Corporate bonds usually offer higher interest rates than government bonds, but come with a higher level of risk. High-yield, jump bonds. These bonds offer high interest rates but carry a higher risk of default. They're issued by companies with lower credit ratings and are better suited for experienced investors willing to take on more risk. Savings bonds. These are low-risk bonds issued by the government, often designed for individual investors. A popular example in the U.S. is the Series I Savings Bond, which adjusts for inflation. Benefits of investing in bonds. Bonds offer several advantages that make them a smart choice for beginner investors. Stability. Bonds are less volatile than stocks, providing a sense of security in your investment portfolio. Regular income. With bonds, you can enjoy a predictable stream of income through interest payments. Diversification. Adding bonds to your portfolio reduces overall risk by balancing out the higher volatility of stocks. Capital preservation. Bonds are a great option for preserving your capital, especially if you choose government or investment-grade corporate bonds. Risks of investing in bonds. While bonds are generally safer than stocks, they're not entirely risk-free. Here are some risks to keep in mind. Interest rate risk. Bond prices move inversely to interest rates. If rates go up, bond prices fall, which could lead to losses if you sell before maturity. Credit risk. If the bond issuer defaults, you could lose your investment. Researching the issuer's credit rating can help you assess this risk. Inflation risk. Inflation can erode the purchasing power of your bond's interest payments over time. Liquidity risk. Some bonds may be hard to sell before they mature, especially in a low-demand market. How to buy bonds. Investing in bonds has never been easier, thanks to the various platforms and methods available today. Here's how you can get started. Through a broker. Many online brokerage platforms like Fidelity, Charles Schwab, or Vanguard offer access to bonds. You can search for bonds that match your investment goals and purchase them directly. Bond funds. If you prefer a hands-off approach, consider investing in bond mutual funds or exchange-traded funds, ETFs. These funds pool money from multiple investors to buy a diversified portfolio of bonds. Government platforms. In the U.S., you can buy Treasury bonds directly from the government through the Treasury Direct website. Corporate websites. Some companies issue bonds directly to investors. Keep an eye on corporate announcements to find such opportunities. Building a bond portfolio. As a beginner, it's essential to build a balanced bond portfolio that aligns with your financial goals and risk tolerance. Diversify. Invest in a mix of government, municipal, and corporate bonds to reduce risk. Laddering. This strategy involves buying bonds with staggered maturity dates to ensure a steady flow of income and reinvestment opportunities. Reinvestment. Reinvesting the interest earned can help you maximize your returns over time. When should you invest in bonds? Bonds are a great option in various scenarios. If you're nearing retirement and want to preserve your savings. If you're saving for a specific goal, like buying a house or funding education. If you want to reduce the overall risk in your investment portfolio. Remember, the best time to invest in bonds is when you're looking for stability and predictable returns. Tips for beginners. Start small and gradually increase your bond investments as you gain experience. Focus on investment-grade bonds to minimize risk. Keep an eye on interest rates and market conditions. Use online resources and tools to research and compare bonds. Don't forget to diversify across bond types and issuers. Bonds are a fantastic way for beginners to start investing with confidence. They offer stability, regular income, and a way to diversify your portfolio. By understanding how bonds work, the different types available, and the risks involved, you can make informed decisions and grow your wealth over time. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.